A Minsky moment refers to a period of distortion in the financial system which invariably ends very badly. Both Vanguard and Guggenheim are suggesting that current market valuations have gone way beyond what is normal, and this must correct. They are not suggesting that we will have another 2008. Rather, it seems more likely a 2000 scenario, a time in which the Fed pressed on the pedal for no reason, the market went to the moon, and we ended up seeing an industry shredded, investors losing their shirts, mass job losses, and the irrational exuberance took hold and rolled itself into the ridiculous housing bubble. What a mess. You came here for the truth, so let me unveil that for you. Today we're going to talk about the 2020 shock. Now I know there's already about 15 comments down below suggesting I am saying something's going to happen in 2020. I don't have a crystal ball, so make that very clear. We're looking today primarily at Vanguard and Guggenheim. I'm going to show you that from these mainstream media articles quoting these interviews. I think it's really important to look at all of the data that we're getting, whether it's coming directly from the Fed, whether it's coming from the BLS, whether it's coming from independent sources, whether we're looking at the analysts and what they're suggesting. We are not simply taking one. None of them are correct. But when we start to piece all of them together, we get a big picture. We start to understand what's going on. The puzzle pieces coming together give us that understanding on a deeper level. Once we start taking apart all of the layers, things start to make sense. But if you look at one thing and one thing only, the stock market, you're going to get a completely different image than what's actually going on. Well, I wanted to talk about the market right away. Global stock markets have increased $17 trillion in value in 2019. They didn't mention the fact that in 2018, the markets were all down, but regardless, this is where we are at in 1 year. It's obviously been so fantastic, and we know exactly why. I want to talk about the balance sheet of the Federal Reserve today. I think it is really important to discuss. That'll be later on in the video, but for now, you can see what has happened with the market cap all around the world. It's massive. It has grown tremendously, and all thanks to what central banks have done. Congratulations, central banks. You have devalued currencies all around the world. Head of the world's largest hedge fund says that report of a massive $1 billion bet that the stock market will tumble by March is wrong. This was Ray Dalio. If you remember, I covered this previously. Essentially, they said that Bridgewater had a massive short position, thinking the markets were going to fall early next year. Now, Ray Dalio came out, said that's not the case, and if you're looking at it, this is part of a whole big bunch of bets. They're always trying to hedge their positions. That's very true. I just want to note the fact that it was Ray Dalio, it was Bridgewater that was shorting Europe back in 2017. Everybody was laughing at him. Everybody was saying that this guy is washed up. And then we had 2018, terrible year, 93% of assets were falling. And suddenly this guy is in every major newspaper, every mainstream article. They were interviewing him left, right, and center. Then he realized what's going on, suddenly comes out and tells everybody that the way that the capitalist system is built is completely wrong. I'm a billionaire. It shouldn't be this way. Please don't get the pitchforks out, and so on. This is what a lot of the billionaires have been doing recently. I think they feel a sense of guilt for the way that this corrupt system has been built up. Joe Davis, the global chief economist and head of investment strategy at fund giant Vanguard, said this: "In the year ahead, we don't foresee a significant reversal of the US-China trade tensions that have occurred so far." Let me make that clear. What's been happening with China and the US over the past couple of years has been an increased tensions, a worsening scenario, and he's suggesting that's not going to change. The stock market has already priced in perfection for the trade deal. Analysts are suggesting everything's going to work out okay. I have seen the line over and over and over again saying a trade deal gets done because it has to, and that is just absolutely ridiculous. And with continued geopolitical uncertainty and unpredictable policy making becoming the new normal, we can expect that these influences will weigh negatively on demand in 2020 and on supply in the long run. Then suggests that both US and China will grow more slowly in the coming year. This is coming directly from one of the highest level people at Vanguard. A lot of people buy into Vanguard and they need to be listening to what the company is saying. Now, are they going to tell you that there's going to be a crash tomorrow? Are they going to give you a warning? Are they going to suggest anything like that of the sort? No, of course not. But when you do get these reports, when you do see these interviews, it's important to pay attention. You're not necessarily going to say, I read this thing on Market Watch and now suddenly I'm going to sell all my stocks. No, I hope not, but you're going to take it in. Our near-term outlook for global equity markets remains guarded, and the chance of a large drawdown for equities and other high beta, meaning more volatile assets, remains elevated and significantly higher than it would be in a normal market environment. Now, it's interesting that they say that, normal market environment. Now, what is it today that makes this abnormal? And I do believe it is very clear to me anyway that it's quantitative easing. Quantitative easing has completely ruined price discovery, created a moral hazard, and it has largely destroyed the financial system. What they have done today inevitably will end in disaster. That's the Minsky moment that we're waiting for. When that comes, I have no idea. But ultimately, this is unsustainable. Simply by printing up money and funneling it through the system, whether it's through the repo market, the term repos, whether it's coming with the quantitative easing that they've done before, Operation Twist, who knows? Either way, that can't actually fix any problems. You can temporarily cover something up, but you can't fix it. And if it doesn't get fixed, you have all these bubbles popping up all over the place, and eventually something gets messy. And in that, we are going to lose a lot of money. We're going to see a lot of wealth be completely destroyed. 401ks, pensions, and everything in between are going to suffer. As the stock market hits record heights, Guggenheim's Maynard says that we're near a Minsky moment and silly season in risk assets. Further along in the Market Watch article, I wanted to point out a few things. Maynard, in a fourth quarter market outlook set to be released on Monday, says that the recent rate cuts by the Jerome Powell-run Fed have established an environment that is similar to 1998 when the central bank delivered a series of rate cuts that produced a liquidity-driven rally that caused the Nasdaq index to double within a year before the bubble finally burst. Now today, we've gone to excessive heights. Imagine how much QE is out there. Imagine with all the extremely low interest rates, what's going to happen? What could possibly happen if we saw what occurred in 2000, if we never fixed the problems caused in 2008? What's going to happen 2020 and beyond? It's going to be unimaginable. And then this quote at the bottom here, taken together, conditions today are characteristic of those that precede a Minsky moment, in which excessive speculation and taking on an additional credit risk during stable markets leads to a tipping point that leads to a period of instability. Many individuals have been pointing to corporate debt as being one potential catalyst. That's mentioned here as well. While the Fed has prolonged the expansion, the reality is that it is also the start of silly season in risk assets. By heeding the lessons of the past, we continue to position defensively so that we can preserve capital and be prepared to take advantage of opportunities when asset prices inevitably reset. That's big as far as I'm concerned. To see something like that written in black and white, to me, it's huge. The Guggenheim manager says one clear sign that markets are on the verge of cracking resides in the spread between high-yield debt and relatively safer government debt, with tightening spreads indicating that investors are more willing to take on greater risk for comparably less compensation in the form of yields. Look at what's happened with the yield curve inversion. We were looking at that. Everything came down into that inverted level, and then of course it has come back up now. And this is usually the moment everybody waits for, because as soon as that starts to steepen, that is truly a warning sign that we are going off the cliff. Risks are building in various areas of the fixed income credit markets, particularly in corporate credit. This is something that many individuals have talked about, and yet again, we're seeing it coming up. Really quickly wanted to point this out. Too big to fail, tech's decade of scale and impunity, essentially suggesting that these companies are so massive, they're so widespread, they can do whatever they want, they can get away with it. I'd like to note the fact that these are essentially arms of the government. They're never going to break them up in the way that people say they will, and if they do, it doesn't even matter. I'm sure they will be valuated at a much higher level, and in fact, they will have even more power. Look at what happened with Microsoft. This company is too big, it's a monopoly, let's break it up, and then they swept it under the rug. Nothing ever happened. It's absolutely massive today, even 20 years later. Repo oracle Zoltan Pozsar expects even more turmoil. Despite the fact that we are only days left in the year for 2019, Zoltan apparently suggests this could still be a problem. This gives you a breakdown of the repos. I'm not going to get into it because I've covered it so many times before, but hit pause and read this if you're interested. In this part further down, he made a point that I wanted to cover. Really quickly, he said this: if the year end is less of a problem because of the repo bazooka we got from the Fed, and if the message of my report played a part in getting that bazooka, then that's a nice way to be proven wrong. But now we're getting into a point in the year when balance sheet problems are going to flare up, and I think the system will get gummed up again. From what I can see in the financial industry, whenever people start talking about the repo market, huge question marks appear. They don't understand it. All they know is that it's a giant, normally very liquid market, and yet at this time, it's having a big problem. We have seen it being a little easier towards the end of the year, but we're still talking about billions and billions and billions of dollars required. How are they going to get out of this mess in 2020? They're suggesting, I believe it was April, that they're going to be able to stop this. Are they really going to be able to stop their $60 billion a month, as well as the repos, overnight repos happening, and the market's going to continue on? It is possible if we have the ECB, the BOJ, and every other letter of the alphabet come in and flood the system with money. Maybe it's possible, but not without that central bank intervention. They're just too used to it. Speaking of central bank intervention, I want to congratulate the Federal Reserve for exceeding $4.1 trillion. If we take a look at this, I know the font is pretty small, but essentially we're looking at $4.165 trillion right now at this time for the Federal Reserve's balance sheet. Hip hip hooray, we have gone into new heights. We are on the verge of going past where we have ever been before. The peak was around 4.5 trillion, and it looks like in January the Federal Reserve will get there. It's only a matter of time. As I've shown you before, if you take the Federal Reserve's balance sheet and you compare that to the US stock market, you see that they are completely correlated. And if I just quickly reverse what I just drew here, I'll show you the only moment in time when we have seen stocks actually declining. If you look at this chart, since they started printing money all the way up here, there was just this one week, right in here, where their balance sheet dipped down. And is it so coincidental that that was the week that stocks declined? Of course not. It is exactly what has been happening, that when they print money, stocks can go up, and when they take that away, stocks will go down. While we have seen so much interest in equities happening in 2019, particularly more recently as soon as they decided to engage in QE4, this article here is talking about the consumption of US debt. At the very bottom, it said this: the share of the debt purchased by investors was the largest since the government began releasing auction data, totaling about 3/4 of securities sold. There is an insatiable appetite for US debt. And why? Because you look around the world and you see all the different countries out there, what they're offering in terms of fixed income. Would you rather buy US debt or would you rather buy Greek debt? And I think the answer is pretty clear, at least in the short term. At each end of Pacific, skepticism over China farm purchases. If you want to know what's going on with the trade deal, definitely read this article here. I don't have time to get into it at all, but essentially they're suggesting that they have no real plan to get to that 50 billion mark. It's ridiculous for those in this industry. They're saying, I don't know how they're going to do it, particularly when they've signed new deals with countries like Argentina and Brazil, but it's all fake anyway. That's all for this video. If you found that informative, hit that thumbs up button. By clicking one button, you support this channel. I do appreciate that very much. Less than 10% of people actually do click, so I want to thank those who spend the time to do so. If you want to build a business, if you want to earn income, if you're looking at passive income, then I have a free e-course that teaches you how to sell on Amazon, teaches you about e-commerce. Check it out at the amazongps.com. It's totally free. If you want to learn about the financial system, if you're interested in the 4 asset classes, the history, all of that is available in these 2 books. I break it down very simply. Check it out at the link in the description. If you want the audiobook, it's available at themoneygps.com. Hang on a second, hold on, don't go anywhere. Have you seen this video? I think it's really important. I know you'll like it. Click on it and I'll see you there.